One thing to know about 83B election is it's all about saving on taxes and eliminating financial issues for your company. Let's assume the stock price rises as time goes on. When business owners and employees are granted company shares, they should file 83B election to pay taxes based on the total fair market value of the stock at the time of granting. But if you don't file for 83B, the increased value of the stock after the start of the vesting period is all taxable. Business owners and employees who are granted stock have to pay taxes based on the fair market value of the vested stock throughout the vesting period. For example, a co-founder of a company is granted 1 million shares subject to vesting. The shares will be vested over a period of 5 years, which means that he will receive 200,000 shares every year for 5 years. Without filing an 83B election, the co-founder has to pay tax on the fair market value of the share vested. Let's say the value of the share increases yearly, from 1,000 to 100,000 in year 1 and grows steadily to 2 million in year 5. In year 1, if the total value of the company's equity increases to $100,000, then the co-founder's 10% value increases from $1,000 to $10,000. The co-founder's taxable income for year 1 will be $1,800. In this case, $100,000 is the value of the firm in year 1. $10,000 is the book value. The co-founder owns 10% of the company's share and receives 20% of the granted shares every year. As the share value continues to grow during the vesting period, the tax liability increases accordingly. The higher the share value, the higher the tax liability. Without filing for 83B election, the co-founder's total taxable income is $101,000. However, if he filed an 83B election before vesting, this notifies the IRS that the elector has opted to report the difference between the amount paid for the stock and the fair market value of the stock as taxable income. The share value during the 5-year vesting period will not matter, as the co-founder won't pay any additional tax and gets to retain the vested shares. He can simply pay tax on the book value of $1,000. File for an 83B election within 30 days of the share's grant date. The IRS is instructed by the 83B option to tax the elector for stock ownership at the time of gift instead of when the stock vests. Then, look forward to the increase in stock value without a heavy tax burden. If an 83B election was filed with the IRS and the share value falls or the company files for bankruptcy, then the taxpayer has overpaid in taxes for shares with a lesser or worthless amount. Unfortunately, the IRS does not allow for an overpayment claim of taxes under the 83B election. Another instance is if the employee leaves the firm before the vesting period is over. Then filing an 83B election would turn out to be a disadvantage, as they would have paid taxes on shares they would never receive. Also, if the amount of reported income is substantial at the time of the stock granting, then filing an 83B election would turn out to be a disadvantage, as they would have paid taxes on shares they would never receive. Also, if the amount of reported income is substantial at the time of the stock granting, filing for an 83B election will not make much sense. Here are some other factors to consider before you file for an 83B election. Consider how this decision would influence your income and capital gains tax on your shares, as well as what the company's worth could be in the future. You can run for election if you are confident that the firm will grow,